Good morning, everybody. Welcome back to the Opportunistic Trader. It is October 10th, and we've had a volatile start to the morning. S&P last is 28.53. We're down 35, so we're down 1.2%. The Nasdaq's down 2%. It's a good day to be joined by Tony Greer of TG Macro. Tony's been joining us regularly, and just last week when he was on, he mentioned being short small caps, being short emerging markets, and social media stocks, and also home builders. And so, Tony, how are you?
I'm good, man. I'm good. As you said, a couple of the shorts are panning out, so I'm happy.
Yeah. So what are your thoughts here? So we took out Monday's lows. We've really gotten off to an ugly start to Q4. Small caps are down. I don't have the actual stats in front of me. I'm gonna pull them up in a second, but we're down, a few percent, 5, 6% in Russell, Nasdaq as well. So ugly start to Q4. What are you thinking?
It's all about the pace of the rate rise. That's the entire trade here is, how fast rates are going to go up. This breakout in 30-year yields is obviously a really big deal for the market. They just bounced from 310 to 340 or so. And that's what's, as we've expected, higher cost of capital is weighing on the housing market. Higher cost of capital is weighing on the broader stock market. Yesterday, the damage was all concentrated in, the chemical names and the paper names. So, a lot of it, this is really, what's interesting is that in the XLB space yesterday, PPG was the biggest stock that got hit. They downgraded, they guided lower, and they said the one thing that we're all looking for and sort of fearing in this economic episode, and that is, they are facing high input costs, so higher raw materials costs. I'm assuming that, the energy market is part of that. They are facing higher transportation costs, and that speaks to the freight market that we've been talking about. That's really really tight right now and very inflationary. And that's affecting their earnings. So it's affecting the bottom line now, in broad daylight of major Fortune 500 companies. And the stock market is, answering to that. So, it's kind of, it's still the same quote has got to ring in your mind from that Druckenmiller episode, that Druckenmiller interview, where he says one of these rate hikes is going to be the one that knocks this rally off of its pace. And since we've seen, the equities behaving in order of, in reverse order of market cap, getting pounded, we're finally seeing weakness in the FANG complex. And it feels like it's time for the market to, pull back. This S&P is in between the 1500 day right now. So I think that 2775 to 2830 is a reasonable range to settle down in. And I think that we've got a little bit more to go on the downside.
Yeah, well, it's interesting. Just this morning, mortgage applications came out, and they were down about 1.5% or 2%, and they were talking about the 30-year mortgage is back above 5%. I think about 5.15 is the average 30-year, whereas that was the highest level since February of 2011, and so that's definitely creeping up there. It's long term, it's still relatively low, but over the past 10 years, that's the highest level we've seen basically. So it's definitely starting to bite a little bit.
That's really important observation. There eventually all of these yields get to levels where large portfolios and corporations actually affect their business and say, okay, at whatever it is at 340 in the 10 year, 340 in the 30 year, or whether it's above 3.25 in the 10 year, they have positions that they say, okay, well, this is the level that we have to go ahead and adjust. And I think that that's what we're seeing now. The bond market's still in a steadily path lower and sort of consolidating in the last couple of days. But, what's changed, the dynamic that changed dramatically is that the yield curve spiked. That's the one thing that, everyone, and I'm not a bond market expert by any means. I'm a very much a pedestrian, but I understand the basic mechanics that when the yield curve is falling and everyone is expecting it to precede a recession, and all of a sudden the yield curve stops falling and spikes on a major event like another rate hike, it's worth paying attention to. So the yield curve hasn't changed trend, but it certainly has bounced significantly off the bottom, because the long end rates are going higher, and the stock market obviously does not like that. And you can take a look at the board right today and see what sectors hate it the most. Semiconductors, social media, technology, everything tech is coming apart. The big leader is going to give up its big lead. in the S&P. Transport stocks are backing off with the higher cost of energy, I think. And it looks like the S&P has just got a little bit more room to fall on the downside if you ask me.
Yeah, well, Nasdaq was the darling of the global financial markets for the past year, and it was up about 20% at one point. I think maybe just under 20%. Now, this second, we're year to date up 10%. So we've had a decent drop there. But you've been talking about home builders, and I have the chart up of XHB, and you've been bearish for weeks talking about it with us, and it has been one of the ugliest charts we've seen in a long time. So my question though is there any level that you'd start to look to pick some of this up? I mean, we're at over 52-week lows here, or is this something you think the trend is still in the favor of lower prices and we're heading lower?
I think that the builders still have more to go on the downside. I just think that their underperformance may start to level off, right? The sector went from overperforming the S&P to being in line with the S&P as we faced an obvious higher cost of capital, in my opinion. And so that when that happened, that's when we got the relocation lower in the builder stocks. To be quite honest with you, Mike, I am pulling a piece of my short off of the table this week. I started nibbling, and I want to take half of it off by the time the week is over, just because it's been a really steep move, and I want to have the capital to put into some other trades that I think are going to get going also. While I think that builders still can back off, I think that, I really like that this 10% move just happened quick. So I'm going to participate. I've started refocusing in that basic material sector where now we've got paper stocks and chemical stocks coming apart. And when I look at those charts, I see a long way to go. So I'm kind of shifting focus over into like a sort of separate industrial arena if that's the way the stocks are going to behave. But I think broadly speaking, the S&P is just going to be, I've been preaching higher vol regimes since January, and that has served me really well as I continue to harvest the VIX on dips to 12. I look for my options plays there, and I get the nice bang for my buck when, directionally the option play goes the right way, like social media going south or builders going south and really inflating my options on the downside nicely. So, this is a good time for me to take that off at the moment. That's all I want to say.
Yeah, and I just brought up that other chart you've been talking about for a while, SOCL. There were times when there was actually even a bounce higher, and you were like, "This is a gift. I'm looking to sell." It was back to that about 32.50 level, and here we are. A clean break, new fresh lows for the year, and I have a longer term chart up here. What's the makeup of SOCL, and are there individual names within it that you dislike more than others?
Yeah, I think Facebook is over as the top, entity in social media on our planet. I think I think that Facebook is going to literally come apart under the weight of its own hubris. Excuse me. I really do. I mean, with the news and face. So to just speak to your comment, the social media ETF, the membership is made up largely of Twitter, 11%, and Facebook, 10%. And then you go to Tencent, which is 8%. We don't have to get worried about that because they are losing the trade war over in Hong Kong, 100-0, and the stock's getting slaughtered. IAC Interactive has been the big bull counter trend name within the social media pullback, and we finally knocked that off its high. And then the fifth largest member is Google, which has finally, started to challenge its trend, we'll say, as well, because it finally today traded back down below the 200-day moving average. But we've seen that so many times before, and the uptrend in Google is still intact. So we'll see what happens. But I think we're going to start challenging these trends. I think that, Scott Galloway's been right all along, and that these massive tech behemoths are finally going to start facing a lot of challenges, right? So I'll get back to the social media ETF because we're talking about Facebook. This week they came out with a camera that's going to go into your house that's obviously going to spy on you with everything you do, and it's going to start advertising directly to you. And I don't think
You have no
anybody's
trust, man. No trust. They're not spying on us.
yeah, right, exactly. Because Mark Zuckerberg said it himself. We're all dumb Fs, right? That's what he called us. So he's just going to try to put a camera in all the dumb F's rooms and have it, soak up every bit of information that it can, and then flood that human being with all of the right advertising, to get the most out of the data that it just took. I think that the entire country is going to blatantly reject that. Begin rejecting Facebook as a viable platform because they're editing news and they're they're shadow banning certain people and kicking people off the platform. And I just think it's gotten utterly ridiculous. So I'm still bearish social media. I think Twitter is, again, also, as the biggest member of the social media ETF. I love the platform for its usefulness, and I think it is absolute garbage in terms of the way it's run. So, until Twitter, sorts itself out, I'm just going to sit here and expect it to go back to where it came from, around $15, and the chart agrees with that. Until it trades above 32, I'm still bearish. And so I think social media's got a long way to fall. I'm taking my chips off of the builders short, and I'm looking around to see what's next. It looks to me like big tech is going to be the next redwood to fall in this bull market.
I know a few weeks ago you commented that you were bullish transports. This was more 3, 4 weeks ago. What are your thoughts here?
Well, they ran into what happened in transports is they ran into the airlines got smoked with oil continuing to rally. The rails are pretty much on track, but the truckers backed off a little bit with the weakness in materials. And so the transports are back into their 200-day moving average support. I would lean a buyer in the transports just because this trend is still intact to me until it's not, but that's how I'm looking at that sector. It's still something on my radar, but I'm not in it yet. It's been so volatile that it's really a little bit, it turns me away trading IYT as a security because of its volatility. As you can see, we've traded this 180, 200 range about 11 times already this year. So it's a little bit hectic.
Yeah. Anything in emerging markets, that's taken the brunt of things as well. Any levels that you'd be looking at, or you still think that given the strong dollar, raising yields, that EM has more room to fall?
I still think I think EEM is going to make its way down below 30. I think the entire rally that took place from 2016, 2017 was a function of the last vestiges of dirt cheap capital. I think it was a function of a generational peak in the bond market occurring in 2016 and people soaking up the last of the free money and climbing out all the way around the world, out onto the yield curve everywhere they could. And I think that was a massive, massive peak in January. And I think EEM is headed all the way back. Let's see, last sale was 40.06. I think EEM heads back below 30 within 9 months to a year. So a 25% pullback over the next year or something like that, because the Trump in the Oval Office thing is really wreaking havoc on all of the countries where people had been parking capital to try to capitalize on higher yields. And that game is now over because the capital is flowing into the United States and out of all the other countries. And when you're trying to get out of other countries and there's a liquidity issue, it just gets really sloppy. And I don't think we've seen the worst of EEM either. I think that thing is going to start gapping down hellaciously at some point later on this year.
Yeah, it's a few bad things lining up for them in terms of higher yields in the U.S. and their currencies as well have been really hit hard. The dollar as a whole, when you take a look at G10, we're not doing a whole lot. Euros at 115, pounds at 132, dollar yens at 113, but EM versus EM, we've seen some significant moves, whether it be Argentina, Turkey, just dollar EM as a basket. Dollar India, very, very significant moves, which also really pressures things. And that chart's pretty amazing. I have it up here for everybody to see. Like you said, it was in January. We got up to 52 and change, and we're trading $40 right now. So that's a 25% move in itself. So that's an interesting one to keep an eye on. We're back to levels in 2014, 15 sort of levels now.
Yeah, yeah, it's definitely getting serious, and I believe that it's all a function of the rate rise that is finally, I guess, toppling the equity rally. And I tell you, I've got one last thing on my mind in the markets that I want to share with your audience, and that is in the biggest stock in the world, which is eating everything, and finally had a really interesting dynamic. So we talked about Amazon, right? The Forbes cover with Jeff Bezos on it is dated September 30th, 2018. And Forbes cover is basically saying, what Jeff Bezos is just looking to figure out what industry he's going to take over next. And if you look at that simultaneously with the Amazon chart, that forms the second top. That exact date at the end of September forms the second top in the double top from which Amazon has backed off mega in the last 10 sessions, 8 sessions. So it's interesting to me that that could be a typical newspaper magazine cover curse type of thing where peak sentiment is reached, the stock trades its high for a second time, and then starts breaking down below moving averages. So I can tell you, I haven't touched Amazon, but on a close below the 100-day at 1820, I am sure as hell going to take a swipe at that runway down to 1635, because I think that this thing could touch all the moving averages really quick when you have a headline like that on the cover of Forbes. And if it approaches the 200-day with some momentum, I mean, think about where the stock market can be.
Well, I
Because
have
this
that chart up right now. Where is the 200-day? I don't have that up.
36. My point is just that, this stock is owned. This is the most widely owned stock by every ETF, every index, every individual investor on the planet. And, if it has a sudden washout, which it hasn't shown that it is yet, but it's had a steep move lower. And if it has this washout, this $200 washout to the 200-day moving average coming, then that's really going to relocate the S&P. I mean, the S&P is probably going to be closer to, I would say, below 2,800 if Amazon gets knocked off that low. So I think that's some really low-hanging fruit there, is to try to take a shot at that Amazon move. It's from 1,800 to 1,600 if it happens. So that's really where I've got my eyes peeled for the rest of the week. I'm going to pick a spot in builders and cover some, sell out of my option volatility here on this bounce. And I'm focusing in on basic materials and the big tech now, most likely Amazon, to see if they're going to have a really steep move lower from here.
Yeah.
Hey Tony, it's Larry. How are you?
Hey, my man, how you doing, Larry?
All right, a little busy, but hanging in. Glad Vol picked up. But I just had one thought or question.
Please.
What's interesting to me is the S&P is basically 80 points off its all-time high, which is like a little, more than 2%, slightly more than 2%, and the volatility is up to like 19. People are panicked and freaking out, and literally we're up. I just looked. We're up 6.8% for the year, and 2% off the high, and everybody's flipping out. So I didn't, I couldn't understand it, and I was wondering if you had any thoughts on it. Are people under hedged? Is everybody massively long? Is there just a massive underperformance? What do you think it is that everybody's freaked out?
Larry, it's the yield market, man. The bond market is, you can't take your eye off it in this inflationary atmosphere and this rising rate atmosphere. Look at the 30-year is a major, major move to me. The 10-year is major.
Listen, I'm in 100% agreement with that, and I thought it would click in.
Let's go. Let's work it out further. What else? Like, how else can we go into it? Because I think that if they can, this is my point. If you think that there is a generational peak in the bond market, low in yields in 2016, we saw a really long consolidation for 2 years after that. If this is where we're going to pull away from that peak in the bond market, then yields can go a lot higher, a lot faster.
Oh, I'm totally in agreement of that, and I think you'll see that. But, I'm really more focused or looking at why people are freaking out. Mike and I were just saying, it's a freak out today, and the S&P is down 90 basis points. We haven't had a 1% close down for 75 trading days?
Today would be the 75th consecutive
75
day
trading days, and
moves.
people are flipping out, and the market is up on the year. No one's selling, and they're, it just feels different, and it feels weird to me just looking at it, And, I think you're right. Yields are probably the cause of this move. It probably should have happened when we crossed 3%. Now at 3.25%, people are allocating around. But in general, just looking at the tape, vol is so much higher than where the market is, and I'm trying to figure out the trade to be done here, versus that,
Yeah, no, it's hard. no matter what, you're looking at the stock market, you're looking at the vol index, and you're looking at 10-year yields or 30-year yields, and figuring out like, hey, what's the exact relationship there. And it's very difficult. But I'm trying to stick to I think that you're very right. In the world has changed. You know what I mean? We're finally, social media. Google, Amazon, Facebook are finally demonstrating that they have the ability to go down. Amazon, we were sitting in a sweet spot there in Amazon when I was goofing around with you guys saying, yeah, this thing's going to take off, right? There's nothing standing in its way, and it would just go up another $100. That scenario is behind us. The world is so much different now. And I think that you're just starting to see these glacial sized portfolios readjust. And I think that, it's these monsters stepping into the market that guys like you and I sense, where it feels different, and it feels like, people aren't being as price sensitive, and they're just plowing that position in or out, whichever they want to be. So, that's heightened up my senses. And I think that volatility is going to continue to pick up, and I think until the S&P finds another lower level, like it's been doing during the whole trade war episode, will it be safe to take another stab at it? So that's why I'm sitting this move out here in S&P, thinking that it can trade lower still. So I don't know. Yeah, I know that I may not have answered any questions.
You have. I was just trying to get some insight or thought into into really more why it feels so panicky. It feels really panicky.
It does. It does.
I'm trading it tick for tick. So like, I feel like I'm in the bunker right now, and it's like, we just bounced basically $10. And when we bounce $10, it's almost like, how like you get that sigh. It's literally like you can feel the sigh of relief. It's like a sigh of relief. And then they're like, okay, we may not have to sell today. You know what I'm saying? But
and it's going to be one of those things, Larry, and it always is, that it's like, it's when the pile up of like the monthly paper statements, it started to be like, you trapped capital is trapped on paper, and it doesn't get untrapped until the monthly statement lands, and they look at it and they say, damn, this thing's killing me. That's down 4% 3 months in a row. I get my broker on the phone.
Exactly. Well, listen, I'll be honest with you. I sit next to a regional firm, Raymond James, and I love those guys. But the bottom line is they don't even have a screen up. They outsource the money. It's being handled by other people, and literally nobody even knows. You know what I'm saying? By the time people realize what happens, if it does happen, it'll be too late. So, I see a lot of that. But no, I was just wondering your thoughts on, I feel it very panicky here. So I was just wondering if you had thoughts on that.
Yep. It does feel panicky. It's, it definitely has to do with, the stocks that were showing no signs of going down are finally breaking. It is the reverse order of market cap thing is going to be difficult. And now, think about this, and it's tough to think about with the S&P at 2,800, but we haven't had any extended periods where, and we've had steep dips in the market, right? But the market dips have been steep in price and short in duration. So for example, just look at the dip in the beginning of the year. The S&P came off to 2,550 low, and within 2 weeks, it was 2,800 bid. So we really didn't wear away at any of those levels on the downside. The second dip we saw this year was down to 2,550 again. And in 2 weeks, it was 2,700 bid. So we haven't seen any sort of wearing down on the downside where you're going to come in every day and the high frequency traders are going to look to sell, rather than looking around to see if the coast is clear to bid Apple up to 220 because nobody will really stop you. It's going to be like, hey, maybe we can offer Amazon down to 1,200 today without anybody really getting in our way, because there's these mutual funds that are trying to sell 20 million shares. And if I can front run them for $40, that would be cool.
Yeah. And I remember about a couple of weeks ago, we were talking Facebook when you were very negative, and we had that 160 unlimited bid.
Yep. I said, right, we wanted to whack the whole thing. Like, what's the guy want? Call him up on the phone and sell it to him. Like, it's going to go lower. And, then you were going to be calling him up again at the 150 bid. And if you ask me, below that Cambridge Analytica low at 149, Facebook is going to start unraveling at a pace that is going to put another look on Mark Zuckerberg's face that we haven't even seen yet.
I don't know. You
Here's the
can't
other
hurt that
question,
guy.
though. Here's the other question. Global markets, S&P's up 5 or 6% now year to date. Nasdaq's up 10. But here's the question of the day, and I don't have the answer. If you take out Apple, what are the markets up? So if you do not have Apple in your portfolio, what, if anything, are the markets up?
Yeah, it's not a lot. It's
it's probably not very much,
difficult.
but everybody's got Apple.
Yeah, if you own an index fund, you own Apple and Amazon.
Everybody's got Apple.
Yeah,
for sure.
That's it. There's nobody on this planet walking around with any kind of savings account in mutual funds that doesn't own Apple. We all own Apple in some capacity.
That is 100% true.
So we'll keep an eye on that. That's where that's what's showing weakness today. Unfortunately, my beloved cannabis sector is getting kicked in the teeth too, but it's probably a little bit overdue. I mean, speaking of small cap stocks getting destroyed, I mean these probably deserve beatings far worse than they're getting today, and I'm prepared to weather that. I thought there was a pretty cool. I want to share one other thing that this is a little bit off topic, but it's worth talking about because it's interesting and it's related to cannabis. Listening to a podcast this morning between Josh Brown and Anthony Pompliano. Anthony Pompliano is really a great crypto expert to follow if you're following cryptocurrency.
Crypto.
And Josh Brown admits that he doesn't know much about cryptocurrency, but he knows a lot about fear and greed, and I believe that. He compared the cryptocurrency bubble to the poker bubble in New York City, which I thought was awesome. And the reason I thought that was awesome is because if you compare crypto to the poker bubble, it's a little bit similar in that the poker bubble took off for a year. Everybody in the planet was reading poker books. Everybody wanted to get together for their poker night. I had people coming at me from out of the blue, like guys down the block trying to have poker night. And then, all of a sudden it was gone, and it's gone, and there's like almost no sign of it. You know what I mean? Like
no, nobody's doing it. You're right. Everyone was online.
Like there's no more broker dealer poker nights going on and stuff like that. So that's gone. And I think that was a cool analogy because I think that, while crypto is kind of gone for the moment and cannabis is taking off, my contention is going to be that like in 5 years from now, cannabis is not going to be gone. And in 10 years from now, cannabis is not going to be gone. Like you don't hear of the poker parties anymore. Cannabis is going to be developing its products and its networks and its distribution and things like that. So I get excited about that. And
I see that. But just talking on crypto, what's interesting? Everybody's stuck long this thing. I know tons of people in my area. Yep. And they're in all these ICOs and they can't get out and they're in these products, and it's like Bitcoin. It's funny, Mike and I talk about it. It's been at 6,500. It doesn't move 100 points. They're trying to now make it legitimate, like that it's actually good. I mean, this thing should go in half again, in my mind. I mean, nobody's investing in it. It's amazing that it's holding up,
It could be, you could just be early to that call. It hasn't really done much to prove that the downtrend is over at all, other than sort of hold this flat bottom around.
Yeah, it's stabilizing. 65.
Yeah, other than hold that flat bottom around 5,500 or whatever it is. But, maybe I'm guessing that somebody's accumulating it there for another day. But, it's still worth watching to me just because of the level of brain power that is exerting itself in that industry. I just have a feeling that all of those smart guys aren't wasting all of their time.
Yeah, maybe. I mean, I just, like you said, Josh Brown's an expert on crypto in a year. We speak to a lot of crypto guys here and we ask their experience. They're like, oh, we've been in it a year. Like, okay, so.
Yeah, no, it's one to watch. It could be. It's one of those things that I don't know yet. It could be just like the poker. Put it this way: this is what gave me confidence in the cannabis trade, Larry. If you had a bet on one of these going by the wayside, like the poker craze, which would you bet?
I would bet that the crypto will be
crypto
gone.
Or cannabis.
I would think crypto. I mean, I don't think there's any use for it. Again,
that's what I think.
Obviously cannabis is real and something you can buy and utilize. So I would have to agree with you.
Yeah. So that, and just on that, and you've been, you and I have gone back and forth about cannabis, and I hear your view loud and clear. I mean, your view is my risk, that kind of thing, where I'm just expecting this market to be way bigger than it's really going to be. And that's my risk, and I understand that. So, but it's good to hear that somebody that's kind of, neutral or not really, immersed in the cannabis trade like I am, to be like, yeah, you know what, if I had to pick those two, or one of them is going to go by way of the poker night, I would say it's crypto. And I kind of agree, just because of the practicality of application.
Yeah, I would agree with that.
Anyway, that was it. I just thought that was a fun sort of trading anecdote. And that's all I got for today.
Yeah,
All
that
right,
was
well,
great.
it was awesome, and I appreciate it.
Yeah.
All right, so that's Tony Greer, TG Macro. As always, great thoughts on themes and what's going on in the market. We really appreciate it. We'll talk to you soon.
Right on, Mike. Take care, guys. Larry,
All
have
right.
a good one.